Hi guys, I'm Chris.
And I'm Jimmy.
And we are the Two Stocky Guys.
On this channel, we invest $1,000 into the stock market every week and then, well, cross our fingers.
Yeah.
So let's start off with the investments that we have had so far. So a lot of my picks have been bank stocks. This last week, the banks have been doing really, really well. Obviously, we had a recent banking and financial crisis, and I think that the recent earnings that came out reassured a few people, at least with the bigger banks. And let's see your picks. So this shows your most recent pick, which is Realty Income. Last time we tried to do this video, it didn't, technical issues. So your other two picks are AMD and ConocoPhillips. Overall, a little down, but not too shabby.
Down but not out.
Yes, yes, definitely not out. So why don't you tell us about why you chose to buy Realty Income? It was like 2 weeks ago or something like that?
Yeah, about 2 weeks ago now. Yeah. So Realty Income is a real estate investment trust. So I'll talk about that a little bit because it's slightly different than what normal stocks are. So with a real estate investment trust, you're not buying a single stock like you are with AMD or Conoco or Bank of America. You're buying into a trust, which is basically a pool of money that the trust fund operators use to invest in different properties, securities, or mortgages, something like that in the real estate market. And they are required by law to give 90% of their income back as dividends. So these are usually very high dividend paying stocks, and that is one of the main reasons that I picked it. The main reason that I picked Realty Income specifically is because REITs do have kind of a tendency to go down in value over time or have very little growth whatsoever. Realty Income is one of the few that has actually shown growth over the last decade or so. So that's the main reason that I picked it, and it does have a nice dividend yield. I think it's actually gone up since we bought it the first time. I think it was right under 5%. Now it's like hovering around 5%.
Yeah.
And the analysts that I was looking at were saying that it was going to go up to 5% or even a little bit higher than that. So the dividend growth, the good actual growth were relatively good for a REIT growth in the stock price, and then the already good, decent dividend that it has right now were the main reasons that I picked it. So a couple pros and cons that you have with REITs in general is, I mean, the main pro is usually when you're in real estate, you're kind of, bought into it. Like you put a bunch of money into a property and then it's kind of stuck there. You can't do much with it.
Right.
A REIT operates more like a stock in that regard because you can pull out whenever you want to.
Yep.
So that's a really good part of investing in stocks in general is just the liquidity that you have with your money. And then it's also fairly diversified because you're not buying one single property like you are with regular real estate. You're usually buying into a bunch of different properties. So if one market is doing bad, that's not going to affect you too much.
Those 2 points are major advantages that REITs have over buying individual properties or getting into real estate, especially as a beginning investor or a investor with limited funds. Like if you go into a property, right, you're investing tens of thousands, maybe hundreds of thousands into a property, and you are crossing your fingers that property is going to do okay, right? Like there's no major disaster. Your tenants, whether it's a business or individual people, are not going to like wreck your place, right? There's like so many variables, and you have to deal with whatever comes up, right? If you get an apartment or rental, right, you're dealing with the plumbing issues, cracks in the ceiling, right? Leaky
Bad
roofs,
tenants.
right? Bad tenants
Potentially.
Like dogs and cats that are, going
dogging and catting all over the place.
Right. Maybe they're smoking in your place when you're just like, no. Maybe they're doing drugs that you don't know of, right? Like these are all problems that you can have if you're going into real estate, and if you do it via REITs, you don't have that because the REITs are doing it.
Right, you're shielded from that, and it's the problem of the fund manager at that point. So that's pretty nice, and you might sacrifice a little bit returns, but you save yourself a lot of headache.
Yeah.
And then you also have that stable cash flow from dividends, which is pretty nice. If you're going for dividends overall, these are usually monthly paying dividends. So you're getting a nice payment every month rather than like quarterly, which you would get with some dividend paying stocks.
People, when they think about having income properties, it's like so glorified, right? Like, oh, you're getting this monthly income and it's like great, right? Like that doesn't tell the story of bad tenants. That doesn't tell the story when, maybe they broke something or wrecked your kitchen or bathroom and you can't rent it out again for another month or two. That's not income coming in. That's your money going out, right? With the lost rents, with the repairs. Like there's just like so many things that I think when people think like, oh, income properties, I think that the reality is that the income coming in is a lot less than what people think,
Right.
because of all these miscellaneous things you have to
they
deal
usually
with.
give you the gross number, which is really high. Like they might say, "Oh, I'm making $10,000 a month," when in reality you're bringing in 10,000, but 9,900 of it is going right back out the door.
Yeah.
And then you're putting a lot of work into.
Yeah, so getting into real estate via REITs and just getting a steady income that you don't have to think about at all and worry about is pretty darn good.
Yeah, it's pretty nice. And then also, I mean, you do have some pretty attractive returns. Realty Income is actually a pretty low dividend paying REIT as far as REITs go. There are some others like Two Harbors, I believe, has like an 18% dividend rate, which is, I mean, pretty high and attractive. But again, if that's one of the ones, if you look at it over 10 years, it's gone down almost 90%. So it's almost had its value cut in half. So that's something that you have to consider. You can't just look at the dividend and say, wow, that's a big dividend, I want that, and go for it. You have to look at a bunch of other factors. So those are the main pros. Some cons that you have with REITs is they usually don't have a whole lot of growth. I mean, even Realty Income being one of the better ones doesn't have a whole lot of growth. And also another factor to really consider is that the dividends for REITs are taxed as regular income, not as capital gains like other dividends are. So if you're someone with a high income, REITs might not be the best decision for you because you're going to get taxed at your regular income bracket, so you can be paying twice as much on those dividends as you would for another company. You can also put it inside of a Roth or something like that to kind of get a tax advantage, but that's a little bit more specific and kind of harder for people with less investing knowledge.
Yeah. The good thing of this REIT that you chose is that it has gone up in dividend growth, right? It's 26 years?
Yeah, just wanted to say dividend aristocrat now, because it's over 25 years.
Yeah, over 25 years of dividend growth, right? That's like through 2008, 2009.
Through all the bad times.
Right? Yeah, through the .com, right? Like that's a lot of years. And if they can weather those storms and continue to pay and increase their dividends, like that's a really good bet.
Yeah.
And it's currently at 5% dividend yield. That means like in a couple of years, that's what, 6, 7, something like that.
Yeah.
That's pretty darn good.
Yeah. So it could be a good long-term hold, not just like a retirement bet, basically. So that's why I picked it for us specifically, because obviously we're not old and gray quite yet. So that's not what we're looking for specifically.
Yeah. I think one of the major cons that people would point out, Realty Income is mostly corporate offices, right?
Right, like, retail spaces.
Yes, retail spaces. And I don't know if like wherever other people are, but if we look around our area, there's a lot of empty offices.
Yeah, a lot of empty offices, a lot of empty retail spaces. And I mean, some of that is just because, the times are shifting. We're moving into a different era. A lot of it's because of COVID too. A lot of things closed down because of COVID, and a lot more things are opening up now that we're finally kind of getting out of COVID. And like you said, in our area specifically, it is like that. But I could say more like where I came from in Louisiana, like the smaller towns, they're still using those office spaces and they're still using those retail spaces because people are kind of out and about more. They're not really buying online quite as much as people like in New York or Los Angeles or something like that.
Yeah.
So people are kind of going back to the office also. So some of the big companies might be moving out of their spaces, like Twitter, and I think Pinterest kind of got out of their place in San Francisco too. But that doesn't mean those places are going to go unrented. They're going to go to a smaller company now or something like that.
I think the real question is that, like, is this whole work from home and companies downsizing, and if we get into a moderate to major recession and a lot of businesses close down, that effect, is that baked into the stock? I don't know, and I would like to think yes for our stock portfolio, right? But like no one really knows, right? And no one really knows like how bad it's gonna get. But again, if you think about like this company has survived 2008, 2009.
Right, I was gonna point that out.
Right,
Yeah.
like is like whatever's coming and going to hit us this year, next year, the year after, whatever, is it going to be worse than 2008, 2009? Probably not. Right?
Yeah, and that's kind of also a good reason why I invest in it, because I feel like, if we are having bad times, if times are shifting, this company has kind of proven over, at the very least, the last 25 years that they're in it for the long haul and they know how to respond to market changes and market pressures like that. So that's why I chose this REIT over really any other REIT. I think that it has that advantage. And also, honestly, like if you look up REITs, you're going to find this one first. Like it's on the top of the page. Everyone talks about this REIT. So it's kind of like, it's like a Disney or a Coca-Cola or something like that. As far as REITs go, like this is Disney.
Yeah. So we did buy that earlier this month for, $62.44. We bought 15 shares for a total of $936.60. It's a little bit less than the $1,000 limit, but you went over a little bit before, so we're about even. Okay, I think that's it for this episode. Please leave comments below. Are you into REITs or not?
Yeah.
Till next time, guys. All right, bye.